Okay.
Well, welcome everybody. My name is Michelle. I think everybody knows Debbie. Joanne, unfortunately, could not be on our final collab call. She was very sad about that, but she's at a conference today, and we just wanted to kind of wrap up as people are starting to make some decisions about how to pay for college. Now that we went through actually getting into college and picking the college, now it's time to pay for it. And so we wanted to make sure you had this good information. And fortunately, as part of our collab, we had Jennifer Cello with Sallie Mae Loans. She's got just a wealth of information about what to think about before you actually take out a student loan, comparing the different loans and that sort of thing. So I'm gonna talk for a little while, and then we're just gonna go right to Jen, and then Debbie, if you want to also join, that would be great. So hold on one second. Okay, let me go back here. Okay, alrighty, I think we're ready to go. So the one thing that I would just say before we get into this is that I find that we tend to think about money in the today. So we think about money like, well, I've got to take out $25,000 a year, so I'll owe $100,000 or whatever that number is. We think of it in static terms, like this is what we actually owe. And so what I want you to understand and what I want you to really think about is if you think you're borrowing $50,000, understand you'll be paying back $75,000 or $60,000. Like it's not, we tend to think of it in today's terms, like, oh, well, if I only have to take out $20,000 a year or $15,000 a year, I'm only borrowing $45,000. That's not how it works. You're actually, people tend to get shocked by their student loan bill, especially if they have deferred it for the 4 years and that sort of thing. So I just want us, if we're going to take out a loan, I want us to think about terms in what we're paying back, not what we're borrowing. Does that make sense? And so I just want us to consider that. So anyway, I think I'm going to turn it over to Jen. And like I said, Debbie, feel free to chime in.
Can I just say one thing, Michelle, on what you just said before?
Yeah.
Is I completely agree. I try and get people to think about the total cost of the loan. So that is what you're initially borrowing and what interest might accrue over the life of the loan. And that's really the best way to compare one loan to the other. It's what is it going to cost you in total when you finally pay off.
Yeah, I agree too. And I think it's also about what is that loan payment going to look like, particularly if it's your student at the end that's going to be responsible for repaying. What is that total loan cost going to be? If you're going to borrow every year, times that payment for year one times 4, can your student afford a $400 a month, $600 a month, $1,000 a month payment? Also consider what their career path is going to be, and making sure that you're not borrowing more than really that degree may pay back.
Right. And I've heard horror stories I talked to this one gal one time, and she said that she had borrowed $29,000 and she was unemployed. She had been unemployed. She missed a few payments, so there were some extenuating circumstances, but she owed like $62,000. Yeah. Like $29,000. Now she owed $62,000, and it was like 6 years later. I mean, I was horrified. But I'll never pay it back because I am paying less than what the interest is accruing. And she's resigned to have this loan for the rest of her life. And it's just heartbreaking when I hear stuff like that. So it just accrues so much quicker than we think it's going to. So exactly what Debbie said, not only think about the payment, but what is the actual loan amount? Not what we're borrowing, but what are we actually going to end up paying back?
Yeah. I was just looking at, we've been doing a lot of research on student loan calculators recently, and PNC has an interesting one that lets you say you're going to borrow $10,000 a year for 4 years. So your total is $40,000. I picked a 9% interest rate, which is about average, and the payback amount, I want to say, was in the like $72,000 to $75,000 range if we were making payments in school, like making minimal payments. So it's almost double what you're going to borrow depending on the rate that you get. one of the things, just talking about that planning aspect, I think is important. So there's a couple decisions that you have to make at the beginning of the process. And I encourage sitting down with your student and having this conversation and being really transparent about it. But first, I think you've got to decide who is going to do the borrowing. Actually, let me take one step back. So first part is figuring out your plan. So Debbie, I know you emailed me a little bit about this part too. So how are you going to divide the, assets that are available to you up over those 4 years? Your cash, your 529s, your investments, any savings, any of your students' earnings. How are you planning to kind of utilize those over the 4-year period? And if you know you're going to have gaps, who's going to be doing the borrowing? Is the student borrowing? Is the parent borrowing? Are you going to do a combination of both? So really trying to kind of map out that plan at the beginning of college and making sure that the student understands what they're going to be responsible for. I can't tell you how many times we hear from students once they've graduated and they have, they get their first payment and they had no idea really what they were in for, because mom or dad kind of went through the loan process for them and they just were like, yeah, sign me up. And then they come out of school and they have, a $250 payment that they weren't aware of. So it's really kind of mapping out that plan and then calculating how much you need to borrow on an annual basis. There are a couple products out there where you could borrow for the whole 4 years and then they'll disperse it annually. But typically we look at, a one academic year. How much do you need to borrow? Consider the whole cost of attendance. So meals, housing, the books, laptops, kind of study abroad or any travel home. How much do you need so that you kind of have that plan for the year and you're not incrementally borrowing and adding additional loans on for the year? The other piece is once you've set up that plan, if your student is planning to borrow, in my opinion, they should take the direct loans first. Those are the, typically the lowest cost. They have the lowest interest rates. You may have the choice between subsidized or unsubsidized. If you can, you also want to try to make payments on those unsubsidized loans while your student's in school to try to minimize the interest that's accruing. But I always start there. I've already told my guys, you're getting those, $5,500 a year, no questions asked, and then we'll figure out the rest. So that's kind of, in my opinion, the first step when you realize you have the gap.
Can I just make a little comment about this too? So understand that even, and I know you're going to talk about this, even if you co-sign a loan for your student, please understand that this is your loan. Like, even
You're
though
both responsible,
right? So if the student graduates and doesn't get a job right away and 6 months goes by and they don't have a job, you're responsible for that debt. If you try to buy a house or a car, depending on the size of the debt, of course, but let's say in year 3, now the debt is substantial and you go to try to buy a house or a car, your credit will be dinged. This is considered your debt along with the student. And if the student has no income, then it's your debt. And so I talked to some acquaintance of mine, and she said, my son is going to film school in Chicago, and we live in Florida. And I said, oh, film school in Chicago, what, interesting. She works at the Y, so she's a single mom. So I'm like, wow, that's pretty expensive. And she said, well, this is his loan. He knows this is his loan. And I'm like, he might really believe that, he might really think that, but you can't squeeze blood from a rock. If he can't pay it, it is your loan. And so I just want to make that, I think we sometimes forget, we just think, oh, they're wanting to do it, it's their dream, we're going to support them. But please remember, this is your loan as much as it is their loan, even if you're just the co-signer. So just wanted to make that point.
Yeah. So that is a big point too. We hear a lot on the Federal Plus parent loans. So, your school will send you the award letter, and a lot of schools will automatically, you'll see a little 0 at the bottom, and it's because they have indicated that you're eligible to borrow the Federal Parent Plus loan. And that PLUS loan is solely in the parent's name. But we'll hear a lot of stories that parents say, oh, well, I took out the loan, but my student's going to actually be paying that back when, they graduate, even though the parent is the one that signed off on that and is legally obligated to repay that loan. The student technically could walk away scot-free if you borrow, 100% on the PLUS side. So in terms of that plan, the school will likely offer you PLUS. They may point you to what's called a lender list, where you can look at either a historical list of lenders that have worked with that school, or a preferred list, which means they've gone through kind of a vetting process before the school will agree to put them on that list. And that's the point where you kind of want to shop and start comparing. You want to compare, apply for private loans if you need to go down that path, and apply for the federal loan as well, and compare those rates. You don't want to just go with the PLUS loan because it's easy and the school recommended it to you and you can click a couple buttons and it doesn't require credit. You want to compare, because if you have a strong credit profile, there is a good chance you will get a better rate than PLUS. The PLUS loan also comes with an origination fee. So that origination fee gets removed from the amount that's dispersed to the school. And then you are accruing interest on that disbursement fee for the PLUS loan. So you really want to weigh your options and look at the total cost of borrowing between a private loan and a federal loan before you kind of just jump right into the federal loan boat.
Jen, can I just say one thing in terms of like this shopping around? Because I'm familiar, and I don't know if you know of another, I'm familiar with two sites that kind of claim to be marketplaces where you can kind of see lots of loans, and they're not bad, but I found they do not actually have all the possible lenders out there. So people should just be aware that just because you go to a site and they say we're a marketplace, they don't have all the lenders.
Right.
And
So
one more thing about the PLUS loan, just real quick. Sorry, Jen.
Yeah.
I find that the PLUS loan lets you borrow more than you can actually comfortably afford. And so this is where we come in to talk about, find out what your payment's going to be. Make sure this is a realistic payment that you can do as the parent, even if the student has said they're going to pay it back. Because like I said, if they don't have a job, if they don't, or they have a job and it doesn't pay, you're on the hook for that. And to get a parent loan forgiven is really difficult. Like horrible things have to happen, like a student has to pass away or something. Yeah. So we hear all about loan forgiveness and loan, all these loans can be forgiven. Maybe for the student, maybe after 20 years, that parent loan is in your name. And so I get nervous about the PLUS loan. I don't think it's a good deal. What I try to tell parents is if the only loan you can qualify for is the PLUS loan, that probably means you shouldn't be borrowing. And that's a tough thing to hear, but just be mindful of that is what I would say.
Yeah, the PLUS loan has very, very limited criteria. Essentially, you cannot have defaulted on a prior student loan or have, I believe it's a bankruptcy. Those are maybe the two knockout criteria. There's maybe a couple others, but those are the big ones. So they will, lend to really any parent who has a student and who has filled out the FAFSA. That's the other thing we didn't talk about. In order to be eligible for some of this federal money, you do have to fill the FAFSA out. If you haven't done so, then you won't see those loans listed on your students or loan options listed on your student's award letter. Trying to think where we were. So in terms of comparing lenders, Debbie brought up a good point about the marketplaces, and some of those will have pre-qualification tools where you can enter in some of your information, social security number, your student's information, and they will pre-qualify you and give you some rate options. It's limited. Not a lot of the lenders like to give over their lending criteria to the marketplaces. We are one of those. So at this point, we don't have a pre-qualification tool at Sallie Mae. But some lenders do, and it's a good place to shop. I also recommend that you, if you bank with somebody who offers student loans, if you're a member of a credit union, that's a good place to look. Check who you have your mortgage with. I usually tell people to at least apply to 3 or 4 at a time. And that way, the key thing is people say, oh, it's too many inquiries on my, on my credit bureau, but it's not. The FICO score takes into account, they have algorithms that recognize that you're shopping for a particular thing, like shopping for a mortgage, shopping for a
I've heard, I don't know the exact, I'm going to say between 3 and 4 weeks, that it takes into account if it has an inquiry, the same type of a loan in a 3-week period, it knows that you're shopping and it actually use it as one inquiry.
Correct. Yep. So, so in addition to that shopping, don't hit accept because you think it's the best rate. Go through the process for all of them. Take your time. I'm a spreadsheet builder. Build your spreadsheet. Compare your rates. Compare the total loan costs, the repayment options. The other thing that I actually sat down with a friend back this time last year. Her son's at University of Tampa, and she had applied. She said, I applied for this parent loan, and I'm like, did you mean to apply for a parent loan? Because there's 2 different types. There's a parent loan that are offered by some of the private lenders where just the parent is responsible for repaying. And then there's co-signed student loans where it's the student and the parent or guardian, whoever else wants to co-sign, they're equally responsible. But we sat down, she said, this is the rate I got. And I said, that rate doesn't look that great. Who's got better credit in your house? And she said, well, everything's in my name because I stayed home and I pay all the bills. And I said, all right, let's get your husband to apply. And so she went on. I always recommend my big competitor, Discover, that everybody goes to their free FICO score tool and plugs in their FICO score. If they have a spouse or somebody else who's going to be helping the student, have both people do it. And whoever has got the higher FICO score is the one ideally who should apply. They're going to get a better rate. So when we went through that process and applied with her husband's information, or she had him apply, the rates that they got were much better. So that's something to kind of know your FICO score going in. I am a big fan of the FICO score. We've had a partnership with them for a long time. They are the score that 90% of the lenders use. So, and that's across all, lending products, not just student loans. You can get a Credit Karma score. It's not necessarily the most accurate, and not that many banks are using the Vantage score, which is what Credit Karma uses.
That's big. Thank you, Jen.
Sure, I'm a big FICO fan. So, so in terms of the other thing that's important when you're deciding what type of loan product that you want, again, I just mentioned before, do you want a parent loan where you are going to be solely responsible for that loan and for paying it back, or do you want a student loan where you co-sign with your student? So parent loan has some advantages. You may get a better rate because you don't have a student on there. You may get a higher rate conversely because it's only one borrower on the loan, so it's seen as a little bit more risky. But you're solely on that loan. The student's not responsible for paying it back. On the flip side, if you co-sign a student loan, you have the option to help your student build credit. So they may not have had any credit at this point. If they're just an incoming freshman, they do not have a credit file. This gives them the chance to start to build up that credit, and also for you guys to share the burden. Now, like Michelle said, if you have a kid who does not have a job out of college, that burden's likely going to fall to you. But this gives them, the chance to start building a credit profile. If you're making payments in school, they're building payment history. There's four or five factors that go into the FICO score, and different credit products are one of them. So if they have a credit card, you get them that they're, you're sending them off to school with. Now they have a student loan. Perhaps they have a car payment. They're starting to kind of diversify the credit vehicles that are on their profile. And now if they're making in-school payments, or perhaps you're making the in-school payments for them, they're building that payment history, which will help them build up that FICO score.
And there can be, sorry, about the in-school payments, it can be actually pretty low. You could do like a $25, month payment.
Yes. Usually when you get through the process, when you get into the application process, they will show you a screen which will give you all of your choices. So some lenders will let you pick your repayment option. There's typically four. It's the $25 fixed payment while you're in school, deferred interest-only payment while they're in school, or some lenders offer full principal and interest payment while you're in school. So let you pick that. Some lenders will assign a term. It may just be 15. At Sallie Mae, we have a calculation based on your year in school, which repayment option you pick, your indebtedness. It's kind of a behind-the-scenes calculation. So we calculate the term, the repayment term.
Oh, so you
for you.
pick your term?
And not at Sallie Mae, no. Discover's another one.
Yeah.
It's the flat 15.
Right, right.
Citizens let you pick 5, 10, 15, and they actually give you an incentive for picking 5. You get a better rate.
Right, right.
So College Ave is another one they let you pick. But it gets confusing because now you've got 3 or 4 repayment options, a choice of variable or fixed interest, and potentially 3 or 4 repayment terms. So you're looking at this combination.
Give you a different, the combinations are going to give you a different rate.
Right. The combinations may give you a different rate. They're going to give you a different month in-school payment, post-school payment, and then total loan cost. And I think the other thing to note is that term doesn't actually, so if they say we're going to give you a 15-year term, that is 15 years from the point the student graduates plus 6 months. So they have a 6-month grace period after school where they'll continue to either have their payments deferred or make whatever in-school payment choice they made. And then that term will start 6 months after graduation or after they leave school. They don't have to graduate. If they've separated from school for whatever reason and decided not to return, they still have that 6-month grace period, then the repayment process will kick in.
Jen, I know we get a lot of questions about how long does this process take? When should people start, applying because they want to make sure they get the money in time?
Right.
How do they actually get to the school?
So Sallie Mae, we have a credit window that lasts about a year. So you could apply almost as soon as a year in advance. The other lenders vary.
Yeah.
So you could start shopping well in advance. The challenge is you have to pick your school. So you have to generally know what school. If not, you're going to have to call the call center and have them swap that out for you. But you can apply. You could start shopping now. I mean, this is the time. There are a couple lenders, small lenders, usually like SunTrust is one down south, that'll typically have a rate sale in the summer, and they may give you an extra discount. But you can start shopping now. You should have gotten your award letter. You may not have gotten your bill. We typically see once people get the bill, that's the moment of panic, and they're like, oh my gosh, I need the funds. So if you start now, you'll have the funds, you'll know what's, available to you. And then the process. So it takes, depending on the lender, anywhere from 5 to 15 minutes to go through the application. Your student's applying, you'll want to have your student there with you so that they can do their part and then you can do yours. Typically you'll get an instant decision, but if they need more information, you'll get a screen and a message that'll tell you that. You can, if you have a more mature student, you could have them apply, somebody who's maybe had a couple years under their belt, you could have them apply on their own first, see if they qualify, but typically the cosigner helps them get approved and helps them get a better interest rate. So you apply, you get your decision, you have to choose your repayment option like we just talked about. So you kind of have to make some of those decisions. You have to sign loan documentation, and when I say sign, it's more e-sign online. And then once you have that, once you've accepted the loan terms, it goes into a right to cancel period. So there's a mandatory right to cancel period of a couple of days. And then once that's done, it goes onto a file and the lender send it over to the school to be certified. Now, every school certifies on a different cycle. So they may certify weekly, biweekly, monthly. So it could be if you applied now and went through the whole process, made your decision, accepted your terms, got through right to cancel, it could sit there until August. We send notices like, don't worry, it's still pending certification, and you can log into your portal and you can see it's still pending certification. Typically once, August starts rolling around, that's when we'll start to see the flurry of kind of certifications coming in if the school's in kind of a waiting mode. But it really depends on kind of how the schools set it up. And once the disbursement happens, I mean, the fastest it could happen at Sallie Mae, I believe it's 7 business days from like applications approved to disbursement. But that school piece is kind of the hitch, depending on how often the school certifies. In a peak season, they may do it every day.
Yeah, and the family doesn't have to, once they obviously have signed the loan, they don't have to worry about, I have to get the money to the school, because that's what the certification is. And then basically the lender, gives the money over to the school.
Right. So it's actually an important topic. So say, you've decided that your gap is $15,000. That's how much you need to make sure that you've gotten everything covered for your student for the semester or for the year. So the school will evaluate that. So the school may say, if you try to borrow more than what the school's cost of attendance is, and that's really what's kind of written up in your award letter, you try to borrow more than that, there is a chance the school could push back. And they may say, no, Sallie Mae, we're only going to give Debbie $13,000. So they would certify that, and then that's what we would disperse. The school will also designate how many disbursements should go out. So that's where I was talking earlier. It's important to figure out what you want for the whole year for a couple reasons. One important thing to know is the school will say, okay, we realize this is going to cover two semesters or 3 trimesters. So they'll break it up into equal amounts to cover each of those semesters. And the money will not start accruing interest until it's been dispersed. So if it's a $10,000 loan, $5,000 goes to the school for semester 1, you're only paying interest on that first $5,000. And when the second $5,000 is dispersed in, say, the spring semester, that's when you're paying interest on the full 10. It's also important to note, if you have chosen the interest only in-school payment option, you're going to be paying a lower in-school payment semester 1, and when the second disbursement goes out, it's going to double. A lot of people get caught off guard. We send a letter saying, hey, just a heads up, your second disbursement's ready to go out. Your payment's going to go up, from $35 to $70. So I mean, it can be pretty seamless, but we don't recommend waiting. You get the bill and the bill's due tomorrow. You're going to have to contact the school and let them know that you submitted a loan or submitted a request for a loan to kind of pay the bills, because you don't want to do anything that would hold your student up from like registering or starting classes or any of that stuff. So better to get it kind of done sooner rather than later.
And what about like the loan servicers? Sometimes you take out a loan with one company, but then you end up having to actually interact with a different company once you're paying back. Yeah,
most of the big lenders are servicing their own loans. Discover, I think, was using Great Lakes for a little bit, but they've brought it back in-house. Or a lot of times they're using a servicer and you may not know it. They're just branding it as Discover or whoever the lender is. You see the servicers, at least from my experience, more with the federal loans. So the direct sub and unsub, you'll get assigned a lender there, or a servicer there. Plus loans, you'd get assigned a servicer, and there's one of a number of them. I don't have a ton of experience with this yet, but from what I understand, you could get assigned a different servicer for every loan. So every year you could be.
Absolutely can. That's why you need to keep track. Exactly.
Yeah. So that's one of the things that I recommend is from day one, starting that spreadsheet with your student to track all of their federal loans and their private loans, because there's not any one place you can go to see all of that information. You can get a little bit of detail on the credit bureau, but it's critical to kind of keep track of those the lender, the servicer, the loan numbers, the phone numbers, the amounts, everything.
You could have 8 loans that you keep.
Right. Yeah. That's it's kind of a more recent recommendation, but we've been saying it's better to borrow for that full year because you've got one loan, and then you have 4 at the end versus having 8 or 12 or however many your school has. Plus you have your child does the federal direct loans, you have those in addition to potentially either the private loans or the PLUS loans. So it's a lot to kind of keep track of.
Yep.
I think another thing we talked about was just some of the loan perks that are out there. Typically, everybody's shopping based on interest rates. That's the first thing that folks look at. Origination fees is another. There are, PLUS does have an origination fee. The direct loans have an origination fee. And they typically announce those in the May timeframe. So I think they're getting ready to announce the rates for the federal loans. And then then the fee comes out in the fall. So it's two different combinations. So I just lost my train of thought. Where was I going with that? Oh, in terms of like perks. So you have your interest rates. You don't want to pay an origination fee on a private loan. There are one or two very small lenders that will throw an origination fee in there, typically more on like an MBA loan or a grad loan, but no, do not pay an origination. Don't pay any fees of any type in terms of application fees, origination fees, that sort. You have your repayment option choices. A big thing is cosigner release. So if you have chosen a student loan and you have co-signed it, you do have it out, but it's not until after your students graduated. The cosigner release requirements vary by lender, but Sallie Mae has the shortest cosigner release period, which is at 12 months. And then some have up to 24 or 36 months. Excuse me, background noise. Sorry. Kids in the kitchen. So cosigner release, what has to happen is the student has to typically make either 12, 24, or 36, depending on the lender. You have to make consecutive payments of the full principal and interest amount. And then, or you could actually pay a lump sum if you wanted to in advance. But you have to make an equivalent of 12 full principal and interest payments with a Sallie Mae loan, and then the student can submit an application to the lender requesting to have the cosigner released from the loan. The cosigner cannot do that. The student's got to do it.
Is there an income requirement sometimes on the students?
It's a combination. So they're going to look at ability to pay is the big thing. They're going to look at your student loan payment history. They're going to look at your credit bureau. They're going to do like an debt to income ratio kind of analysis and see if they think you can afford the loans on your own. So that's cosigner release. So not all lenders have it. Discover does not offer cosigner release.
I know. I point that out to people a lot just because I think that's a huge thing. You might choose to do that, but you should know. People won't even, they go in and they're going to go with Discover and they haven't even realized that.
Right. Exactly. There's other things. Oh, go ahead.
It's probably also, sometimes they say, well, Discover gave me the better rate. Well, there is a trade-off. They gave you that better rate because they're not letting you out of the loan. Exactly.
They've reduced their risk by not letting you off there. Right. There's other perks. Oh, there's another thing that Sallie Mae offers, and we are one of the only ones. I think there's one other small bank that offers what's called a graduated repayment plan. So when you graduate, it's actually just when you leave school, you have your 6-month waiting period and then 12 months after. So within that first 18 months of leaving school, you can call Sallie Mae and say, I'd like to go on to the graduated repayment period or plan. And what they do is they actually reduce your payments to interest only for 12 months. So once you get out of grace for 6 months, then you have 12 months of interest only payments. Now, the thing is, it's going to increase your payment amounts later. It may increase your total loan cost by a little bit. It doesn't, on a $10,000 loan, it's only a couple $100. But it's going to increase that total loan cost a little bit, but it doesn't extend your term. So it's not dragging out the loan a lot longer. It's just kind of giving a little bit of relief when students are in that transition period. So they maybe have graduated, they're just getting their feet under them, they've gotten a job, new apartment, car, all that stuff. They're still trying to figure out their budget. So that graduated repayment gives them a little bit of relief. And there's another lender that has it, and I forget, it's one of the smaller lenders also offers something similar to that. But anytime in that first 18 months, you could call us. So if student makes the first couple payments, it's like, wow, this is breaking the bank. I don't have money to eat. Call us up, in month 9 and say, okay, I need to go on graduated repayment. And then they start that 12-month period at that point. So
it's kind of similar, well, it's maybe a better situation where they can actually, maybe after a few years, like lump sum, like give a bigger payment, to start to pay off faster.
Yes. Yeah. So I can't speak for the other lenders, but I know in our payment portal where you log in to set up your payments. So that's actually just a key point I want to throw in. ACH or auto debit discount. Most of the lenders offer them. So you want to get in there and sign up for auto debit. If you're making in-school payments, you'll get a 0.25% interest rate reduction. So you definitely want to take advantage of that. And you can, in the case of Sallie Mae, you can actually go in and set up a payment amount that's greater than your required payment that's due. So if you say you're making, $50 payment, now you want to pay $100, you can go in and designate that $100 to come out every month. So yeah, that's a great piece. And there are a lot of tools out there too that'll kind of model repayment options for you. So once you're in that full P&I, you can put in calculations and play around with it to say like, okay, if I do X, Y, Z, how quickly can I pay this loan down?
Exactly.
So my friends at Discover have a wealth of calculators on their site. They have, we have our loan calculators down right now, but we have, they have a good one that can kind of help you do some comparisons and just model potential total loan costs, things like that. In terms of benefits, trying to think, we hit on some of the big ones. A lot of the lenders are giving FICO scores to both the borrowers and the co-signers. So that's a great way for your student to kind of keep track of their credit health throughout school and monitor that and hopefully see their FICO score continue to grow. And a lot of times they're given them to the co-signer too, so it's a good thing. So as you're getting ready to go, do your loans for sophomore year and junior year, you want to make sure you keeping tabs on those FICO scores, because even the slightest change in your FICO score year over year, we had a lady on the phone the other day, oh, my FICO score is pretty much the same. And when we looked her up, she had about a 30 or 40% drop or 40-point drop. And so she went up to the next, pricing point. So that's, a critical thing is kind of trying to keep that, it's striking the balance between, maintaining your credit, taking on additional debt so you don't kind of drive your credit score to a point where you have trouble qualifying for a loan.
Yeah, and I have a question about the cosigner release.
Sure.
If a parent is released or cosigner is released, does the interest rate stay the same from what it originally was? Now that the student is taking on by themselves?
Yeah, that's a great point. Yeah, because that was what you signed off on.
Right.
When you signed those loan terms, it designated what the interest rate was, so that does not change. So that's a great point. And there's no real way to know who was making those 12 payments, those first 12 payments. You just typically see that a payment's being made on the loan. But the big factor will really be kind of that debt to income ratio. The only other thing is like a couple borrowers or a couple lenders have like ancillary benefits, or we call them borrower benefits. So at Sallie Mae, after your loan is dispersed, we give borrowers access to Chegg Study. We call it our Study Starter benefit. So they get 4 months of Chegg Study, 4 months of Easy Bib, which I wish we had in college, because you upload your paper and it proofreads it for you and makes sure you didn't plagiarize anything, helps you write your bibliography. And then they also have, they get 30 minutes of access to live tutoring. So they can, be up at 2 a.m. studying for a physics exam and go on Chegg and type in the name of a tutor and and have a one-on-one session, like a Skype session with a tutor. Discover has a free, has a good grades reward.
I
So-
know one of them did. Okay, yeah.
Yep. So for, I believe it's on a loan level basis, but basically you have to log into your portal, submit your GPA. As long as it's over a 3.0, they're going to give you, I believe they mail you a check for 1% of your loan. So if you have a $10,000 loan, you could get a $100 check.
And then do some of them, like, I don't know if this is for sure, but like Citizens, if you are an existing customer there, they give you maybe an additional discount of some sort,
Yes.
another, relationship with them.
Yeah. Discover sometimes will throw out special offers on customer discounts. They do a lot of targeting of their credit card customers for their loans. They may offer it. Wells Fargo does, as well as Citizens. So you'll get your normal 0.25% interest rate reduction if you sign up to get your payments automatically deducted, and then you'll get another 0.25% for that customer relationship. I think it might be Wells that, depending on the level of customer you are with them, like how much money you have saved or invested with them, it could go up to a full point.
Wow.
If you include the auto debit. So there's they've got some pretty hefty rewards, but you've got to be one of their top tier customers.
You have to not need the loan.
Right.
Yeah. Well, we've talked about that too. Some people, we actually just did a phone interview with a customer who basically kind of shops for the rates and compares them to his investments. If the interest rates are better than his investments, then he borrows. He's like, I'd rather borrow and make more of a return on my investments than use my investments to pay for school. So yeah, people probably not, the 1% are out there kind of doing that type of shopping, but yeah, it definitely does exist. I'm trying to think, were there any other things? Oh, I don't know if we talked about this, but just my biggest thing was, I always encourage everybody, even if you can only make that $25 payment a month while the student's in school. We have some stuff on SallieMae.com that actually talks about, on a $10,000 loan, just making that $25 payment could save you up to 12% on the total loan cost.
Wow.
That's the right number. And then if you make the interest only payments, I want to say it's close to 20%. I should know these numbers as the product owner, but you save a significant amount of money if you're able to do that. The one thing you just have to think about is, because you can't change it once you've signed all your paperwork, you're locked into that in-school repayment option. So if you're not sure, you can defer, but then still make those payments. You can go online and see what interest is accruing and make those interest payments kind of on your own, if you don't want to commit to making the monthly payment.
Oh, that's a safe way of handling it.
Yeah.
And that can be done on the direct loan as well, right? You get the loan statement and you can make.
Yeah, you can make your payments. So yeah, I just encourage everybody to, make those little payments while in school, and it also helps the student build up their payment history. Anything else that we didn't cover? I just wanted to peek at my list of things that we had.
While you're peeking, I think I covered a lot. I think that, for anybody who's watching this later, the thing that I think to emphasize is that you can do all of this research and math now. You know what I mean? So
Right.
nothing should be a surprise.
Right.
None of the numbers should be a surprise. And you can, you make some guesstimates, and you can do this for the next 4 years, so that you can come up with that number of when they graduate, what's that payment going to be? Right.
Definitely have the plan. Definitely sit down with your student and make sure that they're in the loop. I know, I have a tendency to perhaps do a lot of things for my kids. But you don't want them to get caught off guard. We hear so many phone calls from students that, even though we send them, so that's one thing, some schools, actually some states have it mandated that the schools have to send the student what's called an annual summary letter that gives them, it's like a debt letter, and it tells them all the money that they borrowed between private and federal. Sally Mae actually sends an annual summary letter to our students every year to let them know. And then before they're transitioning into repayment, so like a month or two before they graduate, we start sending them communications like, hey, we know school, you're getting ready to graduate. Here are the things you need to start thinking about. And then as they get, I think it's like 2 months out, 3 months out, we actually say, this is your estimated payment. So we let them know this is what your estimated total loan payments are going to be, so they can start preparing. So even though I'm sure it goes into, you know, a vacuum freshman year, they go through this process and they forget about it and they go off to school because they're not worried about it because the bills are paid and they're, you know, taking their classes. It's just important to kind of continue to engage them throughout their school, you know, their schooling, and making sure they're aware of what this debt is, assuming that they're the ones who, you know, that you co-signed the loan with them.
But that's actually a good point. Is kind of where the communication goes, because that could be, you know, just a source of, you know, the parent thought they were going to get it, but it really goes to the student's email, and then the student doesn't look at their emails because they don't like to look at emails, and you know.
Right. Yeah. Yeah. They. That's another. It's a good point. If your lender has a mobile app, download the mobile app. If you've co-signed a loan, you should be getting those communications as well. You should be getting statements, but download the mobile app. You know, your students on their phone, encourage them to download the mobile app and set up push notifications so that they're, you know, aware when payments are due or payments are going in. Yeah, it's a great point on just keeping the lines of communication open, or, you know, make sure you have their email password so you can get in there and see what's going on.
What about, this is, you know, an unfortunate thing to talk about, but I think when, you know, you talk about loans, you kind of have to, but, you know, if something were to happen to a student, you know, what happens in terms of the liability of the loan? I guess I'm talking about, you know, tragically, if a student were to die.
So, in the case of a student loan where the loan has been co-signed by the parent, if the student passes away, I can speak for Sally Mae to say that the loan is written off, and parents are not obligated to repay that. And that is in the case of the student passing away or being permanently disabled. So there's paperwork that could be filled out to kind of go through that process. In the reverse case, where God forbid something were to happen to the parent, the parent would be removed from the loan and the loan would kind of continue. If there were disbursements that were still scheduled and in progress, those disbursements would be, I believe those disbursements would still continue, because they don't want to disrupt kind of the students' flow. They've already been disrupted enough. They don't want to make it any more difficult. So what'll happen though in the next year, it may be difficult for that student to get approved on their own. They may have to try to find a different cosigner, someone else to cosign for them. In the case of a parent loan, if the parent passes away, and in some cases, a small number of the parent loans, they'll be co-signed by another parent or another adult. So if there's a co-signer on the loan, the person who passes away or becomes permanently disabled is dropped off, and the other co-signer is fully responsible. In the case of there not being a co-signer on the loan potentially could be, they could potentially go after the estate for that.
Really?
Yeah. It kind of gets in order of, you know, you're going to have, it's a prioritization from what I understand. So, you know, the mortgage is going to come first and some other things. So there may not be anything left. Or if the loan amount is really small, the lender may not decide to kind of go after it. It may not be worth the expense to kind of pursue it. But that's another consideration in the on the parent loan front. It reminded me of something else in terms of cosigners. So there is a chance that you could apply with your student and you cosign and you get what we call soft declined. So your student is still eligible for a loan, but for some reason that individual that's first cosigned is not. You have the chance to add other cosigners. So the student can then invite a new cosigner to apply for a loan and co-sign that loan for them. And they can really take unlimited options in terms of adding different, parents, grandparents, aunts, uncles, brothers, sisters, spouses, really any credit-worthy adult can co-sign a loan. So, if one of the parents is, not necessarily in good shape in terms of credit, or maybe they borrowed for another student and they're kind of maxed out at that point, there's always the option that other adults could co-sign the loan for them as well.
Great. A lot of information.
Yeah, this is great. I'll send over a summary in the next couple of days.
Okay.
And I'll send a link. I think, Debbie, you put together a nice spreadsheet
Yeah.
on the Road to College website with
Yeah.
the different loan, kind of here's the interest rate, here's the thing. So I think that's a good resource. So I'll send a link to that. And then certainly if you have any questions, we're here. I'm going to send, Jen, I'm going to send your information if you want to send me a link to perhaps your loan products.
Sure.
I'd love to get that out to everybody. I think Sallie Mae offers a quite a substantial, they're in the student loan business versus a company like Discover, which is in the loan business. So, I'm not saying, and I shouldn't have used a name, but
That's all right.
products, right? So, but what I like about Sallie Mae is they are in the student loan business. And so I think you have some extra things that people could use. So if you want to, you'll send me the link, I'll send that out in the email as well.
Yeah, that would be great. And if anybody has any questions, definitely feel free. I'll give you guys my email address and phone number. If you have any questions, feel free to reach out.
I'll put that all together. I'll put that all together in the email summary. So.
Okay. All right. Great.
Good. All right. Well, ladies, thank you so much for coming on tonight. I'll get this. It is recording. I'll go ahead and stop the recording, and then we can kind of take it from there. So. I think this will be great. Thanks so much.
Okay.
All right.
Thank
Bye,
you.
everybody.
All right. Bye-bye.